The President of the United States of America, Donald Trump, recently suspended 25% tariffs on Canada for 1 month. But the proposed tariffs created serious tensions between Canada and the United States. And of course, there were also third parties that wanted to capitalize on this tension.
US, where the self-imposed deadline set by President Trump to introduce trade tariffs on Canada and Mexico is fast closing in.
Breaking news out of the White House, where US President Donald Trump has signed tariffs on imports from Canada.
Just hours before a trade war was set to commence, a partial step back from the brink. President Trump saying he'll delay 25% tariff for 30 days while talks continue.
One of these parties, China, was itself targeted by the United States with a 10% tariff imposed and has become an importer of Canada's oil and natural resources almost every day since the completion of the expansion of Canada's Trans Mountain pipeline. A tanker load of oil sands from the line has passed under Vancouver's Lionsgate Bridge on its way to refineries in the Pacific. These tankers bound for China and Japan marked an important shift for Canada, which had long been busy exporting large oil flows almost exclusively to the United States. Whilst President Donald Trump's tariff threats highlight the risk of Canada and the United States trade dependencies, the success of the $34 billion Trans Mountain expansion provides an opportunity for Canada's break away from its unpredictable neighbour, which also provides an opportunity for Canada to play a greater role in the global oil market. In conjunction with Canada's global ambitions, China was competing fiercely with Japan for access to Canada's oil reserves. By exporting Canada's oil reserves, the Beijing regime plans to increase its own reserve, which could further intensify the rift between Washington and Ottawa. But Canada made an unexpected move that China did not see coming on the shipment of energy resources, including oil and LNG, and gave Japan some welcoming news. We will now take a deeper look at why Canada chose Japan over China and its tax disputes with the United States. We will also discuss the implications for the international economy. But first, please don't forget to subscribe to our channel, turn on notifications, and give us a like to stay up to date with our content. Alberta, Canada's oil and natural gas producing province, is looking for alternative export for energy due to the tariff threats from the United States administration and aim to bring Canada's LNG to Japan. Yes, you heard that right. Canada is looking to Japan instead of China in the run-up to the imposition of the United States tariffs. Alberta's Environment and Protected Areas Minister, Rebecca Schultz, has been meeting with industry trade associations in Tokyo to discuss Canadian energy exports to Japan. One of these meetings emphasized the critical importance of LNG to Japan's energy security. Also, that with reliable LNG from Canada, this will reduce emissions and strengthen economic ties between the two countries. Considering these statements, it has become clear the importance of a Canadian LNG export project to Japan this year. Some Canadian officials suggest that this is due to the United States President Donald Trump's tax practices. They say they have been forced to expand the scale of their export for fear of facing different tariffs in the future. Noted that Alberta has geographical advantages over the United States, with the Alberta-Japan LNG and other exports being much shorter than the United States Gulf Coast. Japan believes that the province currently presents less geographical risk than the United States. Alberta is working on 4 or 5 projects for additional capacity. Canada has seemingly chosen Japan over China, but this does not mean that a deal cannot be struck. The director of the Energy Resources Development Division of Japan's Ministry of Economic Trade and Industry set up meetings in Tokyo and relayed recently that they are truly looking forward to receiving LNG resources on shipments from Canada. The Chinese may still miss this critical opportunity to receive oil and gas supplies, which are important for the Chinese regime and their global ambitions, particularly as economic and diplomatic experts say that Canada will export liquefied natural gas to Japan at a 0% tariff rate. there is a scramble underway in the United States for a planned $44 billion LNG export project in Alaska. However, it may already be too late for that. If Canada stops trading crude oil with the United States, there are a variety of potential downsides. This includes higher consumer costs, a reduction in the support for American goals of expanding international energy exports to global allies. The existing integration of the North American energy infrastructure means that diversification efforts away from Canada will be costly and time-consuming. Despite being a net exporter of oil and natural gas, the United States aims to help Europe and allied Asian countries reduce their dependence on less friendly energy sources by meeting growing domestic demand. American resources are plentiful, but energy-intensive data centers running artificial intelligence and other technologies are straining capacity. Canada's stable energy production has the potential to contribute to the United States supply through integrated pipelines. This would give the United States a boost for exporting oil and natural gas to its global allies, which would avoid increasing prices at the pump for domestic consumers, one of President Trump's key priorities. This was likely the plan for the energy relationship between the two countries if tensions had not recently erupted because of the United States. Canada's share of the United States crude oil imports has grown significantly over the past few decades and now represents more than a fifth of total United States oil consumption. Cross-border pipelines deliver heavy crude oil directly to the United States refineries, which are specially designed to process it. For these refineries, particularly in the Midwest, moving away from Canada's heavy crude oil will expose them to geopolitical risks, higher remediation costs, or reliance on alternative sources such as Venezuela. More recently, the Trans Mountain Pipeline expansion has tripled Canada's capacity to ship oil to other markets, allowing Canada's oil to play a role in supporting global allies such as South Korea and Japan. The recent crisis has further deepened Canada's relationship with these countries. Electricity is also on the list of potential United States losses. While the United States generates most of its own electricity, Canadian sources help keep the lights on and costs low in several American states. New projects such as the Hydro-Quebec Hertel-New York interconnection line aim to meet 20% of New York City's electricity needs, further boosting electricity exports and saving residents an estimated $17 billion in electricity costs over the next 3 decades. With more than 30 cross-border transmission lines connecting Canadian provinces to American states, Canada is essential for ensuring cross-border grid security and serves as a potential source of incremental generation. For example, the rapid growth of artificial intelligence technology, a strategic priority for the United States, is expected to lead to a sharp increase in electricity consumption from United States data centers. Data centers are forecasted to account for up to 12% of total United States electricity consumption by 2028, compared to 4.4% in 2023. However, a dispute over tariffs in the coming days could disrupt all of these United States plans. Canada, on the other hand, claims that it will not be as affected as the United States. The Canadian government's reasoning is tied to the efforts to develop trade relationships in Asia in the short term. There is an urgent need for Canada to realise its economic interests with the United States. Whilst the United States can manage on its own, it will face a harder, more costly and longer road to self-sufficiency. The changing economic and geopolitical environment requires both countries to cooperate in 3 key areas of mutual benefit. This strategy relies heavily on the United States being willing to cooperate. There is believed to be very little time to convince Washington of the need to collaborate in the resource and energy sphere, which has been weaponized by several non-allied actors. Canada, for its part, also needs to get its internal affairs in order. The NDP announced new election commitments to impose tariffs on Tesla electric vehicles, restored the federal EV rebate, and doubled the rebate if consumers purchase a Canadian-made plug-in vehicle. One leader, speaking in Canada's automotive capital and border town of Windsor, Ontario, told reporters that if President Donald Trump follows through on his threat to impose tariffs on all Canadian goods, the Canadian government could impose a 100% trade tax on Tesla products. A resource-driven economic and trade strategy will require billions of dollars in new infrastructure, including railroads, posts, and processing plants. Both domestic and foreign capital will only be willing to invest if there is a stable regulatory environment and reliable pricing in the markets that are often highly volatile. However, these are not new challenges for Canada. In short, tariff tensions have caused significant problems for both countries, and actors in Asia are looking to capitalize on this situation. Time will tell how Canada and Japan's energy deal will ultimately affect the dynamics between Washington and Tokyo. But we're interested in hearing your thoughts. Please leave your comments down below, and don't forget to like, comment, and subscribe, and turn on your notifications so that you know when we upload. We'll see you in our next video. Thank you for watching. Bye.